I often tell clients, you tell me when you're going to die and I'll tell you exactly when to take Social Security. You just have to do our best guess as to when to take it and really where does it fit into the financial plan.
Welcome back. We've got a fantastic topic for you today on our podcast, joined by my co-host, Tom Moran. What's going on, my friend?
Looking forward to this topic, Don.
This is one that is closer to you than me.
Thank you for pointing that out, Don. I really appreciate people knowing that.
Yes, and I'm closer to it than our guest, Aaron Simpson.
Hey, how are you doing?
Hey, Aaron, welcome. Aaron, you, of all of our advisors, perhaps have the most amount of letters behind your name. And just for the fun of it, can you walk us through kind of your qualifications in those industry designations that you have?
Yes. So I am a certified financial planner.
Okay.
Chartered life underwriter, chartered financial consultant, certified advisor for senior living, and a retirement income certified professional. So really that helps me and helps our clients in navigating their retirement years and really how best to maximize their income in retirement.
Perfect. Well, that leads right into our topic of Social Security and planning for it. How do you plan for it? If you're a high earner, someone who isn't earning as much, what role does it play? How do you allocate capital? Maybe I'll hand it off to you. And where would you like to start?
Well, I think planning for Social Security is one of those things that most clients don't really think about until really a lot of times really after they retire and go, oh my gosh, I got to figure out when to claim and how to claim and what's going to be best for me. So I think it's really critical to make sure that you're working with somebody that can help you plan all that out, because it's not just when you take Social Security, but there's all these other buckets of money and income streams that you may have coming in. And it's really how do you integrate that and make sure it all fits together to maximize the income you have coming in and make sure it's coming in as tax efficiently as possible.
There are a lot of choices people have, don't they? That's more complex than people think. It's not just, with spouse, with working, non-working, children benefits. You want to go to some of the more important options, the decisions people have, rather than just, claiming their Social Security check?
Yeah, I mean, one of the important things is just to make a determination as to when you claim. A lot of times clients will they'll get to retirement age and say, you know what, I'm just going to claim right away. I don't really know if Social Security will be there for me long term, so I'm going to take it while I can.
What's the earliest they can claim?
62. Okay. But taking it that early, you could have upwards of a 30% reduction in benefits. So if you're going to do that, typically those that would choose that, maybe not in the greatest of health, maybe not have a long life expectancy to enjoy the benefits of deferring Social Security for that higher payout. So they may want to take it early. Some of the other downfalls of taking it that early are if you're still working, and that those earnings that you have coming in would offset your Social Security benefits. So you could even see a further reduction in those benefits. So there's a lot of upside to deferring when you're going to ultimately take Social Security.
So if you're working, would you almost always defer if you're working? Or what's the longest you can leave it in there?
Well, the longest would be to age 70.
70, okay.
But once you get to full retirement age, so for most individuals, it's going to be 67 years old. And if you're still working at 67 and you want to claim it, by all means, go for it, because you won't have any reduction in your Social Security benefits by continuing to work. So they will not offset that for you.
So from 67 to 70, does my benefit continue to increase?
Yes, by about 8% a year. So not too many other assets that you have where you get that guaranteed like 8% step up each year.
Yeah.
So that's nice. But when you start to break down the math as to taking it at full retirement age or at age 70, typically you need to somewhere between about 80 to 85 years old is where your break even is. Meaning if you were to take it early versus deferring it, you're obviously going to get paid more by waiting till 70, but you got to live, 10, 12, 15 years to be on the positive side of waiting that long. And so again, that a lot of times comes down to life expectancy. I often tell clients, you tell me when you're going to die and I'll tell you exactly when to take Social Security. So it's kind of, you just have to do our best guess as to when to take it and really where does it fit into the financial plan.
So I'm glad you mentioned where does it fit into the financial plan. How, if I am beginning to think about retirement, how do I look at Social Security when I'm looking at, obviously I know I can look at it as an income stream. And that is assuming it'll be there when I retire.
Mm-hmm.
But how do I work it in? Because I hear you talk to our clients all the time about incorporating that future stream of income as a part of your fixed income portfolio.
Right.
Talk a little bit about that.
Yeah. I mean, you really have to think about Social Security among other income streams you may have. Financial planning, from a financial planning standpoint, you want to match your fixed income sources with fixed expenses each year. And Social Security can be, even for high net worth individuals, still a significant amount of money that's coming in every single year. So and it's predictable. We know what we're going to get every single year, and we know that it's going to adjust for inflation. And knowing that you have that level of predictability and current income, maybe similar to a high quality fixed income bond portfolio, we know it's coming in. That will help reduce the stress on a portfolio. So as we're taking those withdrawals every single year, the stock market doesn't go up every year. So in those years where we're not getting the performance that we want out of the market, it does help give a stable amount of income each year that we can rely on, that which reduces the stress on the portfolio, and we can treat it like a fixed income asset.
I converted into that cash flow into an equivalent from a fixed income portfolio because people think they need an additional fixed income, and maybe they do, but this should be part of their overall allocation because it's some people that allow them to be potentially invest more towards growth, knowing they have this guaranteed income coming in.
Yeah, absolutely.
And so if I'm going to look at that as part of my fixed income portfolio, how much do I allocate to that in terms of a dollar figure? Is that, do I remember that's like net present value? Is that how that works?
Right. So we could estimate the future income payments that you'll receive for the rest of your life, discount that cash flow back to present, and we could put an economic value as to how much that's going to be worth, and then incorporate that into how we would conceivably build the overall investment portfolio, knowing that we have a chunk of money that would be there, similar to allocating to bonds.
That's great. Is that, I know you do a lot of financial planning as a CFP and work with our clients in that vein. Is that something that you traditionally are doing in that planning process?
Yes. So we model out for clients various scenarios of when they could or should take Social Security at 62, at 67, at 70, and show them how that might impact their long-term cash flow and their probability and likelihood of success of never running out of money in retirement, or how to maximize. Maybe you are going to have plenty of money to live the rest of your life, but the goal then is to how do we maximize the value for the estate and beneficiaries? And so how do we continue to grow someone's net worth over a long period of time? And also, too, in that modeling, we look for ways to be tax efficient. So there are some other benefits to deferring all the way to age 70 because it keeps your income in those first few years. Let's say you retire at 65. We've got 5 years before that income kicks in. We've got till 73 before required minimum distributions kick in. So while income's maybe potentially a little bit lower on paper, we can look for strategies where we're converting IRA money in those early years to Roth IRA money so that we can take advantage of that while our income is low, because at some point Social Security will kick in and RMDs are going to kick in, and inevitably clients are in those situations where income starts to spike. The amount of taxes they owe, the premiums on their Medicare go up as their income goes up. And so we want to find ways where we can know how best to turn on other sources of income to manage the taxes over their lifetime.
Now, you have software, I know, that helps you figure out for spouses how the spouse fits into the equation, as far as whether they should, if they have that maybe they're non-working spouse or a working spouse, to explain some of the choices people have there.
Yeah, so one of the things that we'll advise a lot of times for clients, especially if one spouse is a higher income earner or was the sole income earner, they're going to get a much larger benefit payout. And so for them, oftentimes it's best to defer to age 70 while the spouse with the lower income historically can claim early. Maybe not, sometimes at 62, but generally at full retirement age. And they can claim their benefits. Then when their spouse turns 70, they turn on theirs. That spouse would get a step up to half of the higher of the two incomes. So it's just a way where we can turn some income on right away, get it coming in, take advantage of what's there. And then the spouse, so let's say assume it's the wife, she would go from her benefits. Then when her husband turns on his at 70, her benefit steps up to half of his.
All right, let's move forward, and he passes away. Is there any adjustment to her benefit at that point?
Yeah, at that point, she will get the higher of the two. She won't get both Social Security incomes anymore. She'd get the higher of the two, which in this scenario would be her husband's, and she'd step up to his. Another benefit for him in this situation to waiting to age 70, because he's getting the maximum amount of money that he could be getting, and she'll get that for the rest of her life. And so it's another strategy to really just maximize total economic value coming in.
Do I remember hearing that this even applies to spouses that are divorced?
Yes, there's some rules around that. And so we got to get into everyone's individual situation. But yes, if you're divorced, you can claim on your ex-spouse's benefits.
Okay.
And so that in those situations, those might be higher than yours. And so there are some benefits to doing that and weighing out those options.
How do children come into the equation?
Children would come into the equation if they were minors or had a disability, something like that, where that you'd be able to have benefits for them as well.
Any, aside from when you claim early, claim kind of at full retirement or wait, what other strategies do you talk to clients about in terms of Social Security?
There's some strategies that maybe complement Social Security. Again, it's going to kick on income. Mm-hmm. And obviously there are some with the big, beautiful bill. We've got some tax relief, but for some high income earners, they're not going to get the benefit of those tax breaks. There's a phase out for married couples. I think it starts at $175,000 to $250,000, and they'd be phased out from any type of tax relief there. So we try to look for other tax relief options. If they're making distributions from their IRA at that point in time, oftentimes we have clients that are making charitable gifting, but they're taking distributions out of their IRA and then making the gift, not knowing that we could do some qualified charitable gifting so that would reduce the amount of taxable income that they have. Or we look for other sources of income that they may have in retirement as the Social Security and IRA distributions kick in. Could we change the way that their portfolio is designed, maybe incorporate some municipal bonds so they get some tax-free income? or other sources of income, maybe some cash value out of life insurance. There's other creative ways where we can try to keep their income high, but the taxes low.
That's fantastic. Tom, I know that this is something that you thought about and, went through some scenarios about when to take and what does that look like? What did the process feel like as you went through, and was it pretty straightforward?
Yeah, we have software that can just plug in your ages and your spouse's situation and and I think mine was 69 and a half, so it's my optimal. So that's so when I get there, I'll let you know.
Fantastic, and hopefully it'll still be here. That's a whole nother show that we probably need to have, is talking about the deficit and potential impacts on investors.
Now, I think that's a service we provide, with just really for the best interest of our clients. I believe that's just one of the services we provide, is an all-inclusive fee with our money management, I believe.
Yeah, Aaron, you know this as one of our planners. Every client gets a financial plan and has the ability to work with one of our planners. Talk to us about, give us an idea of a client that you've worked with where focusing on this and kind of getting it right really made a difference. Is there anybody that stands out?
Yeah, there's certainly the less assets that you have available for retirement, the more impactful Social Security is going to be, and the more critical it's going to be to get that decision right. Fortunately, a lot of clients we have, it doesn't make as big of a difference, but it certainly can make a big one. And when we run those scenarios out over a long period of time, I mean, it could be hundreds of thousands of dollars of difference into their retirement by making the right decision as to when they take it and how to maximize it.
Really avoiding the wrong decision. Yeah,
I mean, there's definitely situations where clients come to us and they've already made those decisions, and they did so without really putting a lot of thought behind it. And once you make the decision, it's kind of locked in.
Is there a way, if you've made a wrong decision, can you pay back and undo it? I thought I read something where you could actually, if you had started taking Social Security early and realized there was a mistake, you could pay back the Social Security and not. And is that true? Was I accurate there?
Not really sure on that one.
Okay.
To be honest.
Had you had a glass of wine when you read that, Tom?
Okay. I'm going to go check right after.
What about somebody slightly younger right now and the concern, hey, Social Security might not be there for me, or there may be a material change in what that looks like? Aside from saving more, is there anything else that they might want to do differently if that's their perspective?
Well, yeah, saving more. I mean, when we run out financial plans, especially for younger clients, they're going to request, and I'll often suggest that we take in the modeling, reduce down Social Security benefits to 20, 25%. The reality is that at some point, if we continue the way we're going, Social Security is not going to have enough funding to continue the way that it is. And so something's going to need to change. So for some of those younger folks, yeah, we will model something different and then show them where that shortfall is, how much more additional they need to be saving to make up for that.
So if they're planning on Social Security age, they may have to wait. But if the system becomes insolvent, then that may have to defer the age at some point.
Yeah, they'll either make it so that folks like me have to wait longer to be able to get it, or maybe we end up getting a little bit less than what we thought, maybe some combination of the two. Time will tell, but I think it's prudent, the younger you are, to start planning as if there will be some kind of reduction. Best case, that doesn't happen and you got more than you need.
Yeah, that's not a bad not a bad thing. Speaking of having more than you need, do you not have a friend who said, hey, I don't need Social Security, therefore I'm not taking it?
I do. His net worth is to the point that he feels it's not a significant part of his plan. So I encourage him to take it, but that's his choice.
Yeah, that's great.
You always give it away.
Well, that's a perfect example. If you plan for it, you get more than you anticipate. That's a great vehicle to utilize for any type of gifting you might want to do.
Now, more people do that, the plan might be more solvent.
Yeah, true. Ages have to get extended out. Income thresholds are going to have to change. I think we all agree there's bound to be some material change.
Mm-hmm.
Well, Aaron, thanks for joining us. This has been great. A lot of insightful ideas, and certainly for those that are nearing retirement, to start to model these things out. I would say if you enjoyed today's show, found value in it, please hit subscribe, like, share with your friends. But if you have questions as it relates to you and how you might incorporate some planning and thought around Social Security, please look in the link down below. You can reach out to us at moranwm.com. We can connect you with Aaron or any of our financial advisors to discuss how this might impact you. Thanks for joining us, and we look forward to seeing you on a future podcast. All right, we're back. We had to come back to you after determining that Tom was right in his comment around the ability to, if you've started Social Security and you decide that maybe you want to defer it to a later date, you can do so. So, Aaron, just to be clear, Tom was right.
He was right.
But you have to do it within 12 months, and you have to pay back all your benefits. Then you have to apply for this option, but then you can defer to a later date. But you only have to, after 12 months, you cannot undo it.
I just want to give you kudos for being right. Just pulling that out, that was awesome.
I'm known for a lot of useless trivia. In this case, it's useful.
Useful.
Trivia.
And I take back the comment that I said you could have been enjoying a glass of wine.
I might have been doing
may
that
have
too, but I was reading the tax manual.
Perfect.